We are now live. Brian, you want to take it away?
Yes, thank you very much. Hello, everybody. This is Brian Nowicki. I'm the moderator for today's COVID-19 Town Hall for Hospices, Legal and Accounting Perspectives on Commonly Asked Provider Relief Fund Questions. I'm an attorney at Husch Blackwell, a law firm with national scope, and we at Husch Blackwell have a hospice team of attorneys devoted to helping hospices in every aspect of the work they do. And for the past number of weeks, a lot of our attention has been focused on the impact of COVID-19 on hospices, and in particular, the CARES Act relief funds, which has been a dynamic, is maybe a kind word to say it, fluid situation in terms of the rules, the terms and conditions that come out and have changed, and has caused us all to try to grasp it with how do we apply these funds? Can we use them? Do we need to return them? And all sorts of questions. And we're going to try to cover a lot of that today. And to help in doing that, we have a really tremendous panel to discuss all of those questions about the CARES Act provider relief funds. I'm going to take a few minutes to introduce these panelists. First, my partner and good friend, Meg Pekarsky, who has really dedicated her entire career to helping hospices in any number of situations, is going to take us through a few slides to orient us all to the issue, and then she'll be joining the Q&A panel after that. Andrew Brenton is another Husch Blackwell attorney who is part of our hospice team, and he has become the go-to person at our firm for information about the CARES Act provider relief funds and its ever-evolving, ever-changing rules, terms, conditions, and how to apply them in a way that's going to keep you out of trouble or at least help you do that. We're also joined by our good friends at Crowe, a consulting, accounting, auditing firm that has a lot of experience in this area and that we've partnered with on a few occasions to talk about these particular kinds of issues. And I think you're going to find their insights very helpful. First, there's Bucky High. Bucky is going to present a few slides along with Meg. He's the managing director of the audit group at Crowe, specializing in audits as well as mergers and acquisitions. Dan Junker is also joining us. He's with Crowe and has over 28 years of experience in healthcare. He serves as a principal at Crowe and leads the strategic direction of the healthcare internal audit practice and risk services and solutions within healthcare consulting. Also joining us is Stephanie Cerny. She's a managing director with Crowe's audit methodology group. She has over 18 years of experience serving primarily not-for-profit hospice and healthcare entities. And for 17 years, Stephanie led the management and service delivery of audit engagements and consulting matters, primarily for not-for-profit entities. As I mentioned, Meg and Bucky are going to lead us through some slides. And at the end of that brief orientation to the issue, we're going to get to the questions that are hopefully at the top of your mind, and in our experience have been, in the number of settings that we've presented information about these relief funds. It's going to be essentially a verbal FAQs session where we have a number of questions that have come up repeatedly, and we're going to give you our thoughts and insights. The questions aren't going to get all that fact specific. Every situation is very different, and nothing replaces a detailed consideration of all the facts and the resulting case-specific legal advice. We can't give legal advice in the webinar format, but we do want to equip you with the insights and tools you'll need to help evaluate this situation. I'll be monitoring the chat box for additional questions you may want to pose while we are in this webinar, and we'll try to get to as many of those as we can. But now, without further ado, my friend Meg is going to get us started. Go ahead, Meg.
Brian, you're like newscaster quality facilitation there.
I was practicing all night, so.
I know, it shows. It was spectacular. So Brian, I appreciate that introduction. And I thought what would be helpful before we launch into questions is not to give a rehash of what everyone has probably already heard us or others talk about, but I really wanted to do a little rehash of the framework, because I think that, getting back into this at a high level, so then the questions make sense. So, but unlike some of the other sessions we've given, we're really intending to help you operationalize the framework. And so we provided a lot of suggestions about, how do you define reasonableness and whatnot. But here we're going to just devote most of our time to really helping you operationalize those top of mind questions, as Brian said. And these list of 4 things, I sound like a broken record, but in the many conversations I've had with hospices throughout the country, they have come in handy. And so I think keeping them in your back pocket throughout today's conversation, which is balance decisions on the details with the big picture optics. And so this whole idea of, I don't want to be better off as a result of COVID from a really funding perspective. The government, despite there being a lot of quote FAQs, there has not been a lot of formal guidance about what these standards really mean and how to interpret the terms and conditions. I mean, the FAQs are fairly informal method, and they change their answers to questions on a pretty regular basis. And so the other thing to keep in mind is the risk continuum mindset. So as Brian laid out, we can't get into every single fact scenario, but hopefully you'll get enough of the bookends to understand where you want to fall on a risk continuum basis. So here's a visual as to what you can use this money for. So payment will only be used to prevent, prepare for, and respond to COVID. And frankly, this isn't where the money's at in terms of where people are really scratching their heads. It's not that these are not important questions, but I think it's really the second one that is going to be probably the focus of most of the conversation today in the questions, which is it can only be used to reimburse for healthcare related expenses, again, not defined, or lost revenues that are attributable to coronavirus. And so that is probably 80% of the questions we get are in that second bucket. The third criteria is it can't be reimbursed from other sources, or other people can't be obligated to make these payments to you. So next slide, Andrew. So the evaluation strategies, and you've heard me say this before, you need this defense mindset. So expect that the government's going to knock on your door. And if you prepare for that now and know how you would answer those questions and what you would be comfortable explaining, I think that that's how I would approach this. The reasonableness standard, which we're going to revisit briefly in a second, this risk continuum, where you want to fall when there are no yes and no answers. Where do you want to fall on this risk continuum? Because I think that we have clients that, pushing the envelope, I don't know that I'm hearing anyone necessarily use those terms, but I think some people are making different choices in some of these areas. And then another thing to keep in mind is, what's the purpose of these payments? So the payments wasn't to enrich the bank accounts of healthcare providers or others that were receiving these funds, but really intended to make you whole, because there was an understanding that there was people's businesses were being hurt as a result of COVID, or they're having a lot of unforeseen expenses that were due to COVID. And then finally, the number one thing I think, and it's nothing that's written down anywhere, is just this big picture optics. How, when you put all of your puzzle pieces together, what does that picture look like? And are you in a position that the government might say, geez, you look like you did really well after COVID. That wasn't really our intention with providing these funds. Now, that can be a difficult situation to navigate, which is, I think, the purpose of some of today's conversation, is to say, I don't put that on the slide to say, oh, there's such an easy answer to this big picture optics thing. Well, we're not talking about PPP funds here. I mean, the standard for PPP funds, I mean, your business might recover very well, and consequently, your loan might be forgiven, and that might be helpful to your bottom line. Relief funding's, I think, a little bit different. And while you want to keep all of those buckets of money in mind, I think that this is something that's more of a practical approach than it is a true legal or accounting principle. So next slide, Andrew. So the reasonableness and what we mean by that, and so as we start going through these questions, what I would have in the back of your mind is, am I approaching things consistently? So like expenses, like revenue, am I treating those things the same? Or would someone argue that I'm gaming the system because when it's advantageous, I treat these things in this way, but then when it's not, I do something different, which correlates to the idea of what benchmarks are you going to use as a comparative. And so I think if you do a lot of mixing and matching, that at least could be questioned by the government. Now, I've talked to a number of different people where in certain circumstances, it does make sense to use your budget for 2020 for one thing and maybe historical numbers and something else because of, again, unique factors. Next is the necessity of the expense. And I think this is obviously on the expense side as opposed to the revenue side, but it's something, again, as you're trying to brain out why something does or doesn't feel good, and I use that obviously in quotes, is what we've sort of put a pin in is this idea of, well, it doesn't feel very necessary. It feels like something I'm choosing to do, whether it be morale boosting or otherwise, and it's not necessary. And then coverage from another source, that will come up more as we work through these questions, the risk tolerance, and then of course, the big picture, when you add up all of the details, does it look like you're better off? So next slide, Andrew. And this is a slide that you all probably have seen before. It might be in your right-hand drawer. This is just a visual depiction of the standards and some considerations we have. This is where that but for COVID test came in. So but for COVID, I wouldn't have had this expense, or but for COVID, I wouldn't have had this grade of expense or this grade of a loss. And so that's what the slide is intended to cover. So next slide. And so, Bucky, I wanted to turn it over to you now to give that broad framework from the accounting perspective.
Sure. Thank you, Meg. Yeah, just again, some high-level accounting reminders as you all think through accounting for this. Again, these were unsolicited funds, at least the first 30 billion, sorry, were unsolicited funds. And so they landed in your bank account. And so upon receipt for the CFO, the accounting nerds on the call, that's a debit to cash and a credit to deferred revenue until the point when the conditions begin to be met. And so that's whenever that loss of revenue occurs, and those additional but for expenses that Meg just spoke of, when those start to be incurred, and then you can start to release some of this, release it to operations on your statement of operations, your income statement. So that's all under ASC 958-605 for our not-for-profit friends on the call. For the for-profit hospice folks on the call, it's not quite as straightforward. There is no specific guidance for you as it relates to receiving government funding or government grants. However, the FASB has allowed for analogizing to other guidance. And we think a lot of folks will analogize to this same guidance, but do want to make you aware, if you have received funding in the past, you need to have accounting policies and procedures that are consistent. With that being said, there are two other sources of accounting guidance that you may lean on, or at least want to research as you're deciding and making your accounting policy election where you haven't made it previously. And that's International Accounting Standards 20, which deals specifically with governmental funding grants. And then also the gain contingency model that's under ASC 450. And so both of those have the kind of the same spirit to them, in the sense that, you know, initially upon receipt, you're going to set up a deferred liability, and you're not going to start releasing to your statement of operations until the conditions are met. There's a little bit of a nuance as it relates to timing and perhaps some classifications depending on the elections you make within IAS 20 and ASC 450. But again, just want to bring that to your attention for the for-profit folks on the call, that you may need to make a policy election where you have not in the past, to establish precedents. And so again, just not to beat the dead horse that Meg has already covered, but, you know, applying that defense mindset. And how do you do that? Substantial documentation. And then how do you ensure that documentation is correct? I mean, it's procedures and controls in place to kind of govern what's being tracked and recorded. That's ultimately going to be the basis for which you release these funds into your income statement. All right, Andrew, you can go to the next slide. And, you know, one other point we wanted to bring up on this call, and HHS again has not provided written guidance on this. There's no conclusion yet, but given most folks would not have dealt with this in the past, this could be a big deal. And that's related to single audits, the uniform guidance consideration. So typically governmental grants come with a CFDA number, which has not been assigned here, so nothing to follow there. But when that happens and you receive more than $750,000 in federal funds, you're required to have the single audit. And that single audit really hones in on the financial aspect of these grants, the sources and uses, as well as the compliance or controls piece. And usually those controls are defined, and again, they haven't been defined here. So this could change if it comes out and this is required. Companies could have to go out and engage an auditor to perform the procedures around this. But we believe if you're doing everything Meg and team has laid out, and you have that substantial documentation, the additional effort should be minimal. And it becomes more of a reporting and a compliance exercise at that point. So that's all I have to say, Andrew. I'll turn it back over to you all.
And there we are.
All right. And I'm trying to come back on the screen because I think we would now like to dive into these frequently asked questions that we've gathered up from a number of sources and get into those. I'd like to start out with some of the nuts and bolts of the CARES Act relief funds. And Andrew, I know you probably have this information at the top of your head. So I'll direct these to you, but welcome anyone to comment. What is the period of time that is covered by these funds? In other words, when do you have to have incurred these increased expenses or lost revenues in order to in order for them to be eligible for reimbursement from those funds?
Thank you, Brian. The short answer is that HHS has not articulated a specific time frame for the use of the funds, but as we've kind of mentioned and hinted at earlier, one of the criteria for using your relief payments is that, you know, the healthcare related expense or the lost revenue has to be attributable to coronavirus. So, you know, that is sort of an inherent time frame to consider. You know, you probably didn't have many of these losses, you know, before coronavirus, you know, hit the country and people started preparing for that. So, you know, I'd say the short answer is there isn't a specified time frame, but, you know, just keep in mind the purpose of these funds, the terms and conditions requiring that, you know, the qualifying losses and expenses be attributable to coronavirus. And, you know, that should sort of guide when you would consider applying or kind of the, you know, from what period of time these expenses and losses occur that you would want to apply your funds to.
And Brian, maybe a thing to add there is that we expect that HHS will define that at some point of, because naturally, as you're saying, Andrew, we think it's probably going to be the end of this pandemic, but again, no definition around that. I think similar to, we expect there's going to be a format for reporting since that comes due July 10th. This is one of those areas that we think that there will be a sunset period on the use of this money. But yeah, as Andrew said, nothing that we know right now. And so I think what we have been saying to folks, and I think this is something to keep in mind, and maybe I don't need with this audience because you guys are living this, is we're not through this yet. So to know how long you're going to continue to incur expenses and lost revenue, especially now we're hearing dips in routine home care census and whatnot, that could, continue on for several months. And so, I mean, I think that the horizon, practically speaking, in terms of what you laid out, Andrew, are still far from that. All
right, let's talk about the possibility of returning funds. Andrew, this might be one for you as well. Are these funds an all or nothing proposition? Do you have to use all the funds? And if you can't, do you have to return all of the funds? Or can you use some of them? And is there a process for returning the unused funds?
That is a complicated but a good question. So I think that there are kind of two different answers, or two different kind of components I want to talk about here. So the first has to do with how we're interpreting HHS's current guidance on when a provider should return a relief payment. So suffice it to say, there has been a lot of confusion about this area, given, Brian, you said that HHS has been fluid in this area. That's absolutely true. They had put out some kind of confusing guidance in this area, but under the current FAQs that have been updated several times in May, we're interpreting HHS to be saying that you should reject and return your relief payment if either you think HHS paid you an error, or paid you an erroneous amount, or if you think that, or if you anticipate that your qualifying losses and expenses are going to be materially less than your relief fund amount, then HHS says to return that.
Well, and Andrew, let's stop there, because that is such an important and very new thing that came out, this whole materiality standard last week, sort of out of the blue from left field of that. So the error thing, and I think we're interpreting error to be pretty substantial error, like people get, loads more money than, I mean, there's just like no way that it is truly a mistake. But I think this idea of materially, what was the language exactly? It's like,
if you anticipate that your qualifying losses and expenses will be materially less than your relief fund amount.
Yeah. And so, I think that it's hard to interpret this because, again, we're not through this. It's not clear when we're going to be through this or what your time horizon is. And so, while there have been a few people we've called that are just saying, I really haven't had that many expenses. My census has gone up fairly dramatically, blah, 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 state of affairs. Like, that's a little bit different than I think most people are still feeling, and actually the lost revenue is starting to pick up more. And so I think, Andrew, you and I have spent a lot of time talking about that. Is I don't know that changes what we've been saying to folks all that much, but I just wanted to pause there because it's something that came out that I don't know that a lot of folks have been talking about. We didn't make big hay out of it because for the reasons we just described, but it's important for people to be aware of.
Absolutely. And I guess the other kind of piece that I wanted to address, Brian, in light of your question, has to do with, I guess the logistics of returning payments. So HHS right now has not set up a mechanism by which you can return a partial relief fund amount. So they're saying you either accept it all or you reject and return it all. If you do accept it, obviously you'll want to kind of ensure that you're spending it appropriately, which I'm sure we'll get into with specific examples later. And then ultimately you'll want to be prepared to return any amounts that you don't spend on qualifying losses and expenses, even though at this point it's sort of the specific mechanism for doing that is a bit unclear. And then if you decide you want to reject your relief fund payment because notwithstanding the things Meg just mentioned, you just really don't think you're going to have that much losses and expenses to account for here. So what you would do then is you would go into the attestation portal, you would reject the funds, you would return the payment. If you got it through an HCH, you would return it. You'd have to contact your bank essentially and ask them to reject that. If you got the payment by check, you would return the check. And then importantly, you would want to go into this different general distribution portal, submit some revenue information. HHS says that if you reject the payments, you submit this revenue information, they will essentially recalculate what they believe to be your correct amount. So kind of long answer to a pretty complicated question, but I hope I addressed it, Brian.
Yes, thank you. Andrew, one last one on kind of the nuts and bolts. The deadlines for taking certain action have been a bit of a moving target. What are the current deadlines that the hospices should be aware of for attestations and submitting financial information?
Okay, so for the attestations piece, HHS very recently just extended the deadline for attesting to receipt of your payment and that you agree to the terms and conditions. So originally it was 30 days. You have to do that within 30 days of receipt. Then it was 45 days of receipt. Most recently, in the past several days, HHS came out and said you have 90 days from receipt of your payment to go in and attest to your receipt of it and that you agree to the terms and conditions. If you don't do that, then HHS says that after 90 days of receipt, you will be deemed to have accepted the terms and conditions anyway. With respect to the revenue information, so this is a separate portal that you go in and you submit this information. HHS last week said that you have until June 3rd to do that, to submit this information, if you want to be considered for a tranche 2 payment from the tranche 2, the $20 billion part of the general distribution fund. Now, I guess technically, if you don't want to be considered for that payment, that June 3rd deadline may not apply. But if you are going to be submitting that information, especially if you want to be considered for an additional payment because you think your first payment was too small, then you'll want to make sure you do that by June 3rd, which is next week.
Yeah. And maybe, Brian, just to tack on to that, because I think it leads into a question that we get a lot, which is, I don't need second tranche money. Do I still need to submit that revenue information and tax information that Andrew was referencing? And our recommendation to date, this moment in time, May 27th at 12:30 Central, has been, it appears that you should still submit that information if you got a first tranche payment, even if you don't want or aren't requesting additional funds. So that is a little unclear, I think, to lay people, for lack of a better word, that maybe don't spend every single work hour thinking about this. But anyway, I guess that has been our best thinking, that indeed you should put that in. I walked through on a Zoom call with a client last week, so I got to see it sort of firsthand. It's very simple to do that. And so, so anyway, just to put a closure on that point in case it doesn't come up again later, Brian.
All right, thanks, Meg. Let's open this up now and get the Crowe folks involved and start talking more about those losses and expenses. And let's start let's start from a kind of a higher level. What if you have increased revenue and increased expenses? Are those expected to offset one another such that you really don't qualify for any relief fund? The relief fund money for the qualified expenses? Any comment? What's your take on that?
I guess, Crowe team, maybe you want me to take a stab at that. First of all, what I would say is, and this is Dan Yunker, how are you? You know, a lot of the reasonability test goes into this thinking, right? So there's not, because you receive some revenues in your business. So for example, maybe the local area hospital did some additional discharges, patients, you saw the influx of patients. You still incurred other COVID-related expenses to handle that patient population that you otherwise would not have incurred. So you don't need to do the math of offsetting that if it's course of business. We've gotten some discussion today is, you know, make sure that you're not like double dipping sources of funds in the regards to double recognizing a reimbursement of an expense or a lost revenue, and you had another you know, federal source of funds to do so. So it's not an offset for business. Not like you have to net that out, but you do need to make sure you're very careful in regards to the source of funds and making sure there's not a double dipping. I'd ask my team to expand on that, but I think that's the logical way to go at it.
All right, thank you.
I agree.
All right. Let's get a little more specific with losses and specific categories of losses. What about lost revenues relating to fundraising events or donations? We've heard a number have needed to cancel fundraising events because those in-person settings just aren't compatible with all the restrictions. Are those lost revenues able to be reimbursed through the relief funds?
Yeah, so there's a lot of conversation around this, and obviously for all of the non-investor-owned entities on the call and in the healthcare delivery system, this is an important area of revenue source for providers. And it is in my daily conversations with HHS. I have some clarity, though it's not in writing yet. I'm hoping to see this in written guidance at some point. But the way that it appears that they're comfortable is first of all, they recognize this as an important source of income for non-investor-owned entities. So, you know, tax exempt. What the guidance that and the conservativeness that I would follow, and again, I come leading the risk practice here at Crowe, I come from a risk standpoint, is if it's a specific event, you can actually recognize the lost net gain that you would have had from that specific event. So if you give you an example, you have a gala. A gala is the example that HHS used in the conversation that I had with them. You had a gala, and that gala nets you, you know, $1 million or $500,000 or $100,000, whatever it is, but that's your gain on that event. You had potentially expenses incurred to promote that event that you had to cancel. So that could be in the form of marketing materials, so forth, maybe contracts that you had to cancel for hotels or space or other obligations, caterer, those kind of things. You can capture all of those related expenses. Where there doesn't seem to be a comfort level is in the general fundraising area of focus. So for example, it would be probably unreasonable or probably a bit aggressive to say that, oh, we are expecting this big donation from a benefactor, and now because of COVID, that's not coming through. You know, that's a kind of maybe we are expecting kind of moment, and that would not be reasonable. So, but if you can tie it to an event, and then a formula for that we had dialogue about was, you know, how do you determine what that is? Is it your, you know, earlier in the conversation you said, was it your budget for the year? Your budget included a double in size of that event. Is that reasonable? Well, it's probably not reasonable because you never performed at that level. So the conservative approach would be is to take a 3-year average or last year's. And what makes HHS comfortable is whichever one's lower. So your last year lower or your 3-year average lower, whatever one of those is lower, would you imagine that, is the conservative approach to say, okay, that's a reasonable management decision associated with the lost revenues of that event. There's other charitable areas, like some of you may operate, like thrift shops, second, fundraising storefront type of entities. And you had maybe because of state related matters, shut those down. You can recognize that as well.
All right, thank you, Dan. I have a question about sequestration. It has been suspended COVID, I think, to relieve some of the financial pressure. And as a result of the absence of sequestration, that is additional revenue to the hospices. How does that get calculated or evaluated when you're trying to identify lost revenues?
I think I would probably throw that calculation question out to Andrew if you want to jump on that one, if you're willing to do so.
Well, I guess my thought on that would be, and because Dan, you were kind of talking earlier about offsetting. I mean, I would think that if you were to add up your, COVID attributable losses, I don't, know that you necessarily need to kind of offset that against, potential revenue gains resulting from the sequestration suspension. But, I guess kind of to get at points we brought up earlier, this is about a risk continuum. I mean, it's not like there's a very clear answer from HHS on this. So, a conservative approach may be to kind of offset that, but there's certainly nothing, that HHS has put out that would require that. I think it's, just a matter of kind of sussing out the reasonability or the reasonableness of that, and, kind of how comfortable you are defending, that decision in the event that you are audited in the future, or other enforcement is initiated against you.
Yeah, and I can piggyback on that. I think, as it relates to your lost revenue calculation, your lost revenue is going to be lessened because of the 2% uptick because of sequestration lift on the revenue side.
Yeah, I agree with that. And I think that when I've talked to folks about that, another thing to think about too is the difference in GIP rate. So when people have been talking about lost revenue in terms of, the GIP rate went up fairly significantly. And so, comparing that to budget, so I think that this sort of falls in that kind of camp too, is obviously probably makes sense to do what you budgeted for that in terms of like the real-time dollars, and not, the lower rate you got last year because it's lost revenue as of today. And so I agree with you on the sequestration issue, Bucky.
Let's ask a question about lost revenue that's attributable to patient census. With nursing facilities being hesitant to allow outside personnel into their offices, and there may be situations where hospice censuses are decreasing, and that could be for routine home care or general inpatient care. And so first, that lost that decrease in census covered as a lost revenue under the CARES Act? And second, what if there's a difference? What if you have loss in your GIP census compared to past years, but perhaps an increase in routine home care? How do you try to reconcile those two, or do you treat them completely separately?
Well, again, I think you need to take a step back and look at the aggregate impact that COVID caused on the business from a revenue loss perspective, and then you kind of back off of it from there, right? And so it's like the goal here, again, The goal here of HHS is to provide relief funding to try to get, try to create relief. And that's a strong word, relief. And so your role is to say, okay, from management's perspective, what are we applying the relief to? And so we received X amount of dollars, and we believe in aggregate, we lost this amount in revenue because of COVID and we incurred this much in expense. And what is that offset? So it's not like trying to, well, in this area, we had an uptick, in this area, we had a downtick, but we're not going to recognize the uptick. We're only going to recognize the downtick. Unless they're in totally separate entities and those entities receive separate payments, that's a unique situation, right? So, in creating those defensible statements with substantial documentation, I'd be looking at the net effect of that.
Yeah, and this is Meg. I would agree with that in the sense, and this sort of gets into the big picture optics, is if you're looking at things at a micro level, like I could see my routine home care went down to see that line item, but then you don't look at, sort of dial back and see the whole picture when, again, this is not happening from what I'm hearing, but, my GIP went through the roof and, and obviously the payment rate for that is so much more. And so I agree with you. You need to look at the net effect, but I do think when you're evaluating your revenue, breaking it down in those different ways, so then you can see how the pieces fit together. So instead of just saying, I'm looking at my bottom line, I think it is a helpful exercise to break up things and look at them sort of at that micro level, as opposed to just discounting that exercise. You probably heard me say, I think it's better to throw more at the wall and then distill your thinking than say, I don't have anything and you never went through the exercise. Because I think, even as we've struggled to advise people in this dynamic environment, I think the more you think about it, I think that you refine your thinking a little bit more and get more comfortable with the decisions that you're making.
Yeah, that's that word, substantial documentation, right? So I couldn't agree with Meg more. You're creating a defensibility, and the exercise we're going through with our clients in dissecting this is, you start in the aggregate and you come backwards from it, and we go through an exercise. Just throw everything on everything. Here's revenue lost, and here's expenses incurred. Through everything you can possibly imagine on the board, and let's just do a Snicker test on that, right? Yeah. And you'll be amazed how many times, oh yeah, that's actually from your situation, your management's consideration, that's reasonable. And there's other times like, yeah, I get what you're trying to say here, but I'm not quite sure about that one.
Yeah, totally. Well, and I think that it is, I guess in talking with people, I feel that folks are so nervous about scrutiny that it's like they don't even want to engage in that exercise. It's like, oh no, I don't even, this is a hot potato, I don't want it. But I think that the exercise, I think, will help you engage in the process, that then when things come around, if the government ever knocks on your door, that you're going to feel very comfortable with the decisions you made, because you went through the painful experience of sitting in a room for hours and hours and reevaluating and evaluating again. And I think as for providers, this is a very fluid situation that, your balance sheet looks like, fairly good right now. And then you have a drop off of census from your nursing home by 10% in a week. That can have lingering effects for a very long time. And so, things can turn on a dime here. So I think it's not, I did it once and now I'm done. I think it's this sort of constant evaluation. But I think once you put in the effort on the front end, it becomes an easier exercise and much more efficient as you move through this.
Yeah, and if you're following, like Bucky had indicated, you're kind of flowing. You're going through a process here where you're taking this as almost a liability, and you're drawing down on it as you recognize these lost revenues or expenses incurred. You've got a perfect trail mechanism there for defensibility. That's what you want to do, right? That's the right way to approach this.
Let's do one last lost revenue question, and then we'll get into expenses. I think we've all felt in some way the economic impact of COVID-19 with a lot of the state-ordered shutdowns, the loss in the stock market, and so on. What about investment losses? Is that a source of lost revenue that can be covered by CARES Act funds?
Well, I always like to start this conversation because it's a hot one. Yesterday's market was over 500. Today we're up 249.7. Okay. So most of our type of organizations in industry with their audit committees and boards have very conservative investment policies. So, I think if you can materially defense financial investment impact, then I think it's one of those things that you throw on there, and management's got to say, okay, well, this is because of COVID. The market, there's risk in investing. So depending on your investment policy and so forth, maybe if one of your lenders, maybe you have outside lending when you're a lender. I'm just an example. It came out one scenario, defaulted on something because something happened, and you had expense occurred with securing additional financing and had to get that at a higher rate or something. I'm kind of drawing at a scenario here, but this is the process you go through. But general investments and the conversations I've had with HHS is there's a lot of sighing on that one. And I think the market the last 2 days, investments in the market, there's risk. And the market is at, over 25,000 today. So, and could come back. If we had a vaccine tomorrow and everyone and 350 million people were able to get it in the United States, the market probably hits over 30. So, it's a really hard one. I think there's other ways to find a match to the amount of money received than trying to tackle this one. I love the other panelists' thoughts on it, but that's kind of where I'm at from a risk standpoint.
All right. Anyone else?
Well, my non-accounting brain thinks the same way. So for whatever that's worth.
Yeah, I'll go with Dan on this one.
It feels right, Dan. It feels right.
It's kind of it's the process you go through. It's the absolute right question. It's a hard one to defend. So you get to this kind of point of, there's a doubt in my head. I'm not sure the market's increasing right now. Yeah, maybe I got to look somewhere else.
Well, let's talk about expenses. And one of the most knotty areas of that is with staffing costs. Everybody who has been affected by this has had their staff devote an exceptional amount of time to dealing with COVID that they've never had to deal with before. What to do about the additional time devoted to addressing all of the COVID-related items in terms of just human resources? And does it make a difference if the staff who are devoting that time are hourly or salaried employees?
Yeah. So I'll start, and I know the panel has a lot to say here. So first of all, you got to kind of go through that process again. And so there's a couple things that are going on that we hear a lot of. Is we have some organizations from a staff morale standpoint issued a kind of what they're calling a COVID bonus. That is very different than, for example, providing what I also hear a lot in the marketplace, hazard pay. Those are two very, very distinct things. Hazard pay is recognizing that because of COVID, you may be more exposed to something that's harmful to you as an employee than otherwise you would have been. And for several of you in California, as you know, now you got the worker compensation insurance into this conversation. If they're working in the office or in the home front. So that's very different. And that's something you can recognize. There's other scenarios that you have that you have to explore, but you can measure that. If you just gave a kind of a morale builder, bonus, $100 or $500 or whatever it was, gift card, whatever it is, that was a human resource decision and a cultural morale decision. I would not try to recognize that. So that's my initial response on this. But this is a hour-long topic in its own. So I'll let some of the other panelists give their perspective.
Well, I think this is that in the opening slides, that necessity one is this just something that I'd like to do versus necessary. And this is the exact one that made us come up with that, where it's like the morale boost doesn't seem justified. However, mission pay, hazard pay, whatever you want to call it, does. I think some of the other questions you're getting to on staffing, which I feel like come up in every single conversation I have, is about, the salaried folks too, Brian. And I don't know if you want to go there now or hold off on that, but I think that one to me is fairly clear, but I think having Dan talk about that and getting the county perspective is helpful.
Well, yeah, why don't we get into that? And when I've encountered that issue, I've considered salaried folks they're being paid a salary to do a job, whatever happens because of that job. And it might be harder to say that now that salaried folks are working 60 hours a week instead of 40, that extra 20 is all attributable to COVID, and therefore the government should be paying part of that salary, which doesn't go up because of that. Hourly people, you can just track the information a little bit better in terms of what they're doing and why, and so it's a little easier to allocate that. But what's your take on that distinction?
Yeah, so the one discussion that I had is, it's like, if you can track and document, which many of you probably are, that there's specific related work that salaried or exempt or non-exempt staff are doing, like, for example, serving on a committee. You could track that specific hours that, hey, the committee only exists because of COVID and it required these things. And if you really, again, it's almost like the investment. If you really need this one, you probably could create some defensibility around this, but there are some nuances to that. So if it's a salary related person, say an executive in the organization, and they're above, 190, I think it's 192.4. Is that the number? I think in that ballpark. Which is a executive level 2 within the federal government. Take that back out by 2,080 hours, a typical normal work week, and have a dollar value to that, and then the time spent on that committee. As long as the committee is documented, there's minutes, and everything discussed in that committee was COVID related. Now you got some defensibility. So it's, again, one of these gray areas of trying to determine if you need to account for that or not. But again, remember, again and again and again, we come back on this in every single conversation. And I know some of you on the call here, we've been on the phone together talking about things. And this is not about, this is not about the tick and tying of rules. It's about fraud and abuse, right? This is relief funding to assist the U.S. healthcare delivery system. Part of this is stimulus, and it's driving this through in doing the right thing. So, creating documentation and making a management decision that's defensible is really the answer to this question.
And if I could just add, Dan, it's like the amalgamation of, they're not rules, right? But these principles, or whatever we want to talk about them, is you just talked about purpose. What is the purpose of these funds? Like, how you got to that answer is partly, well, what's the purpose of this? And then also, where do I want to fall on the risk continuum? And this defense mindset is, you're going to have to dig a lot deeper, and there's going to be a lot more questions, if you're looking for investment income or allocating salaried expenses. And then I think the more you probably count those things that might be harder to defend, suddenly from an optics big picture standpoint, that principle sort of comes into play. Is like, oh my gosh, I add up, I was more aggressive here, and then I add this up, and it's like, oh my goodness, like that added a ton to my bottom line. So I think that's a great way to see these principles in action, and how you come beyond just that feels right, but is trying to put words to that. And then, because again, the other principle was consistency, right? And so if you have some filters that you're using, I think then you can make consistent decisions about you know, all of this in terms of how aggressive you want to be and whatnot. So anyway, I thought that was a great way to put all of those principles into action.
I do want to get to a technology question because that's another big area, if you don't mind me interrupting.
No, that's
That
great.
is, with COVID, telehealth has expanded, virtual visits, and to accomplish those effectively, hospices may need to buy additional technology, laptops, the ability to do that. That could be software. It could be outfitting your facility and fiber internet to accommodate that sort of stuff. And some of these things can have a useful life that hopefully will extend beyond coronavirus. So how do you attribute, is that entire cost attributable to coronavirus? Do you amortize it, or how do you deal with those kinds of expenses in the use of relief funds?
I'd say check, check, and check, right? You touched on so many things. Technology is a very nice, clear, defensible thing. So you may have had plans to put telemedicine for a long time. But because of this and because of the safety to the patient, because of COVID, because of the safety to your employees, your physicians, because of COVID, are all very, very defensible. And it's all invoice tracked, which is also defensible. And so you know, right now we're looking at our first quarter statements in capturing that expense. There is no guidance yet, and I actually am waiting on a response. You know, I'm on my bat phone here to HHS, and I'm waiting on the text response on this particular topic, which is July 10th reporting requirements. And, there is no guidance yet, and I think Andrew mentioned that as well, or Meg, I can't remember what one of you did. And so we're going to watch that really closely. We'll know very clearly if we have to look at maker's tables and all these things to determine useful life of this equipment. But the reality is again, you take this step back and you say, okay, well, would we have gotten into that, you know, as immediately as we had? Even if you only get 50%, you know, if you look at a typical, you know, spread on that, you get 50% on the front end. That's still a pretty sizable amount. Right now, there's no guidance. So, you know, if we continue to get no guidance up to the 10th, we'll probably look to capture this as a expense. There's other things. We have some clients. There's remarkable things going on in the marketplace as well. Like, we don't even know it, that this is actually transforming the healthcare delivery system. 30-year healthcare vet is unbelievable what's going on right now. And we have executives telling us that the mobilization of things that are happening, would it take a year of planning to even have occurred, are occurring in a week or in 2 weeks because of response. I think that's absolutely terrific. And because I think the long-term effect, that's very positive. But we even have clients who are actually, because the community that they serve doesn't have access, and they're providing them with technology to be able to interface with the caregivers. Again, check the box. So we have phones going out to people, iPads. I'm hearing there's a lot of things that have been acquired by those that are being innovative in the delivery of care. Kudos to all of you that are doing that.
And I see we have about 1 minute left. Was there any final closing comment anyone would like to make to address something we didn't have time to get to?
Well, you've heard my high button is sometimes I feel like I'm the sensible police, right? And looking at this from a risk perspective, when in doubt, pretend I'm the OIG Office of Inspector General, and I'm in your office questioning something. How would you feel about your answer? Mm-hmm. That is really the best gut check you could possibly have.
See, you're talking about feeling. How would you feel about your answer, right? But I think it's really well said, and I know that we sounded like a broken record with those defense mindset, reasonableness, but I go back to them all the time. They took a long time for us to develop those and hone those and put our feelings into words, and then, but you know, use them. But when you start using them, I do think they're really helpful. And I think today's discussion shows how these can be put into action, and that because again, when you're in the gray, I think you can get pulled in a lot of different directions. And so having these things down as you're going through probably these endless meetings of talking about these things, this will be, I think, incredibly helpful. And hopefully you saw that in action today, and that this was, we met our objective of having a live discussion and working through these gray areas, and how the tools we've provided you here can really help you make good decisions.
And I want to thank everybody who listened and watched today's webinar. I agree, Meg, it was a lively discussion, and this is the kind of discussion we have very frequently with people who come with questions. And if we didn't get to a particular question at the top of your mind, please feel free to reach out to any one of us, and we'd be able to answer the question or give you guidance and help you answer that question to make the best decisions possible. And I want to thank the panelists also, our friends at Crowe, Stephanie, Bucky, Dan, and of course, Andrew and Meg. I appreciate everybody's work with this. Thanks all for joining our program. We hope it was very helpful for your organization, and this concludes the webinar. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.